podcast. KCAA, Loma Linda, 1050 AM, the station that leaves no listener behind.
You're listening to an encore presentation of this program, KCAA, the Inland Talk Express.
Well, hello and welcome to International Wealth Builders Radio Talk Show. I am your host, Michelle Estelle, the Homebuyer Coach, here on KCAA Broadcasting Network on 1050 AM and 106.5 FM. We are affiliated with NBC, CNBC News, and NBC Sports, and we cover over 5 million households in the greater Los Angeles area. If you have missed any of our previous shows, you can watch them on our TV streaming device distribution on Roku TV, Amazon Fire TV, and Android. Just subscribe to the Building Solid Foundations channel. Okay, so today I am Michelle Estelle, your homebuyer coach, and today we're going to cover loan level price adjustments. You might have heard this in the news. We're going to take at least a few segments, if not the whole show, to kind of explain and talk about what loan level price adjustments are. And if we have any time, we might go back and touch a little bit on the previous episode last month with generational wealth. I might just summarize that. But we're going to get into loan level price adjustments. About a month ago or so, if you're on Instagram, if you're on the news, you would have heard many outlets talking about how poor credit buyers were going to get a break at the expense of good credit buyers. And that was basically the focus of the conversation. So what I'm going to do today is explain what loan level price adjustments are, because they've always existed. It's nothing new. And we're going to jump into whether or not what we were seeing was true. We're going to jump into if they were trying to maybe cover up something, or the fact that influencers and media outlets were putting it out there and other people were saying that it wasn't true or that it was entirely false. Well, what was actually false about it? What was true about it? And how do we break this down? So let's begin. So first off, loan level price adjustments, LLPA, they've always existed. And basically what that is an add to the rate in the form of discount points for high risk or for risk adjustments for a riskier borrower. A riskier borrower is going to pay a higher interest rate. The reason for that basically is because if a lender has to foreclose on your property, it costs them money. And obviously nobody wants to default and the lender doesn't want you to default. So we'll save that for another time. But loan level price adjustments are for risk. So oftentimes a realtor or a client would give me a call and ask me, what is the rate? Or even, what is your rate? And what I've always said is there's not a one-size-fits-all rate. There's different programs that have different rates. And then there's certain aspects, risk aspects to the loan that will change the rate from one person to another. So the first one is what's called loan to value. The amount of down payment that you have determines your loan to value. So just for the sake of visual, since you're listening to this and you might need some visuals. So easy math, $500,000 home with $500,000 loan is 100% financing. The house is worth 500 and the loan is 500. So that's 100% financing. When you put 5% down, that's 95% financing or 95% loan to value. And so on, 10% down, 15% down, 20% down, 50% down. Obviously, the more down payment you have, the more investment into this property, the more that you have to lose, which can be a motivation for paying your mortgage or selling your home if you have to get your equity out. So that is the first risk to the lender. As I mentioned, if the lender had to sell your home, it would cost them about $30,000. As a sidebar, they also have mortgage insurance when you have a low down payment, and that mortgage insurance helps mitigate that cost for the lender. So they get insurance paid to them when you default. That's what mortgage insurance is, paid by you for the benefit of the lender. Maybe we'll talk a little bit more about mortgage insurance later. So the second risk is a FICO score. So the better your credit is, statistically, the better your performance, your willingness to pay, and your ability to pay your debt may be. So risk in credit performance is the next risk. So if you have a high FICO score and substantial credit, lots of years of having credit, lots of years of paying your debt on time, you are statistically a lower risk. And if you have harmed credit for whatever reason, we all do at times, but if you habitually don't pay your debt or get into trouble or have not had great plans and have found yourself not being able to pay your bills and things like that, or you had an illness or a death or an accident or an illness, obviously those things sometimes make it hard to pay your bills. So some really valid reasons why people might have harmed credit, and then some irresponsibility, let's face it. So your credit score statistically says what risk you are for default, if I could summarize it. And so that's a different risk. Then there's also properties. So manufactured homes and condominiums, they have a loan level price adjustment because the property, and that's just looking at what the lender feels like the lending on a condo and the lending on a manufactured home are a little bit more risky than a single family stick built home. So there's an ad there for a condo, an ad there for a manufactured home. Again, this is an ad in the form of discount points. And the last thing, which really isn't a risk, but was discussed for loan level price adjustments, and there's a little bit of back end things with this, is your debt to income ratio. So the lower your payment is in accordance to your gross income, that's also considered a less risk. So the higher your debt ratio is for the housing and debt, the more risk you might be. So for instance, an FHA loan is more risky because they allow for such a high debt to income ratio, which is why no matter what loan to value you have on an FHA loan, you have the mortgage insurance for the benefit of the lender in case you default. So that's basically in a nutshell loan level price adjustments, and they've always existed and they've changed over time. So this isn't the first time that there's been a change. But the reason why this one hit so hard is, I believe, the way that the changes were made and who was affected the most and who benefited the most. Now, they might want to try to tell us that they might even want us not to think that there is a winner-loser in this situation, and maybe not. However, it is very clear that it is not clear that what the media said, that a person with bad credit will benefit more or have a lower rate. The lower rate part that they say is not accurate. And the higher rate for better borrowers, that's a little bit more questionable. So basically what has happened is for deliveries, not for closings, not for loans just in May, but for deliveries to the two agencies where loan level price adjustments prevail, which is basically your conforming Fannie Mae, Freddie Mac loans, and that's what these LLPAs are, is that these adjustments were shifted where a lower score borrower with a lower down payment, possibly the lowest down payment, does in fact get an improvement to their particular situation. So just in comparison to themselves and nothing else, that particular borrower group that might have a 620 score and only 3% down definitely got a lift. Those loan level price adjustments went down. They're not getting a credit. That was one of the misunderstandings, because the heat map showed that it looked as though they were going to get a credit back, and that the others were going to pay or have a lesser credit. So that was kind of a misunderstanding. What the heat map was showing was how much the change was going to be. So again, for the sake of easy math, let's say that a borrower with a 620 score and a 3% down used to have LLPAs that equaled 3 points. Well, now they might only be paying a 1 1/8 points. So they got a huge reduction in the loan level price adjustment, even though they're the riskiest borrower on the grid. The lowest score, the lowest down payment. So the more harmed credit and the less down got a huge break. They're still paying points. They're still paying LLPA. However, their particular grid, their particular cell on the grid did see a huge improvement. Now, the borrowers that are in the middle of the grid, which I like to call like the middle sector, they have about a 680 score, moderately good score, and they might have 5 to 10% down, which is pretty decent. It's better than 3 for sure, and a 680 score to a 720 score was before considered very good credit, or at least good credit. Well, their loan level price adjustments increased, so they definitely got penalized for nothing. They're just going along having good credit and saving money or getting gifts or whatever their current situation put them in, that they were able to have 5% or more down payment, and they are now paying a higher loan level price adjustment. So no matter how you slice that, it does feel a little off, because the non-risk or the less risk borrower is now paying more, and the higher risk borrower is now paying less, which really feels like what everybody thought, and that your middle sector is subsidizing your lower sector. So that definitely, to me, is the case. So what we're going to get into in the next segment is the message that we got that you should have bad credit and you'll get a better rate, because that one is not quite accurate. So in the next segment, we're going to go ahead and discuss specifically the credit piece of this, and how harming your credit is not going to get you a better interest rate, which is the false part. But the truth is, if you have good credit, you are paying more to subsidize for people who don't have such good credit. That is true. And we'll be right back.
Looking to attract your target market without soliciting or doing the cold calling? Call Marie Waite and book your consultation. Branding gives you the power to create a unique and classy perception of your business for your target audience. A marketing plan without the right branding will always cost more, take longer, and tend to deliver subpar results compared to a well-branded business. Marie Waite is a branding strategist who formulates effective marketing and media programs to promote your business in building your name, brand, and legacy. Marie has over 10 years of experience and a proven record of creating strong brand content for business owners, entrepreneurs, and companies using her creative ideas, recommendations, and innovative programs. Book now at mariewaite.com or call her at 951-378-5316, 951-378-5316.
This is Steve Matley. Join me every Thursday at 3 p.m. right here on KCAA for Building Solid Foundations radio talk show. I spent decades as a professional construction manager, business owner, real estate developer, and a college educator, and I enjoy learning new things from other people. We talk a lot about real estate, business, and finance, but we cover a diverse range of other topics as well. Some of the topics we've discussed in the past few months include real estate investing, leadership, higher education, ADUs, marketing using technology, multifamily rental properties, business strategy, entrepreneurship. You never know who may show up or what they may talk about, so join us right here on KCAA for Building Solid Foundations Radio.
Fire Up Connect is the most innovative business networking group, supporting and collaborating with a dozen of small businesses that are interested in building and establishing strong business connections, hosting educational live seminars while carrying out business and community-driven projects, as well as marketing programs as a part of its membership program. Fire Up Connect also offers virtual assistance with a wide range of services including inbound customer support, chat support, appointment setting and email management, graphic designing, video editing, web design and development, social media marketing, e-commerce solution, content writing, and much more. For more information, head on over to www.fireupconnect.com. Fire Up Connect, helping success stories unfold every day.
Real Men of Real Estate.
Men of Real Estate radio show here on KCAA.
Boats, mortgages can be purchased.
All of us want to live in thriving communities.
Basically, go to the radio station, KCAA radio.com.
You're listening to Fabulous Lifestyle Radio. I'm your host, Ricky Perry, and we are affiliated with CNBC, NBC News, and Sports, where we broadcast to over 5 million households in the greater Los Angeles area. If you missed our previous shows, you can watch us on our streaming networks on Roku TV, Amazon Fire Stick, and the Android app.
Looking to attract your target market without soliciting or doing the cold calling? Call Marie Waite and book your consultation. Branding gives you the power to create a unique and classy perception of your business for your target audience. A marketing plan without the right branding will always cost more, take longer, and tend to deliver subpar results compared to a well-branded business. Marie Waite is a branding strategist who formulates effective marketing and media programs to promote your business in building your name, brand, and legacy. Marie has over 10 years of experience and a proven record of creating strong brand content for business owners, entrepreneurs, and companies using her creative ideas, recommendations, and innovative programs. Book now at mariewaite.com or call her at 951-378-5316, 951-378-5316.
Welcome back to the International Wealth Builders Radio Talk Show. This is Michelle Estelle, your host. I am the mortgage coach. And welcome to segment 2. So we were just talking about loan level price adjustments, trying to get to some of the misinformation on both sides, whether it's positive or negative, kind of misinformation about what was going on with loan level price adjustments and the announcement from most influencers and media that the people who are going to benefit were people with bad credit. They're going to get better rates than people with good credit. So we've kind of already gone over what a loan level price adjustment is, what happened to those loan level price adjustments where people with lower credit scores got an improvement to the loan level price adjustment, and people with better credit scores or in the middle sector are paying a higher ad for what used to be that they had good credit, and now they're paying a higher price. So when I finished the segment, I was saying that are the middle sector subsidizing for the lower sector? Yes. Those lenders or media or whoever that tried to tell us that they aren't, that's not true. However, the way it was explained, I would say, was not quite accurate. So just to recap, loan level price adjustments have always existed. They've changed in the past. This time when they changed on this grid, and if you look at a heat map, basically people with lower scores and a lower down payment got a break. Their loan level price adjustments decreased. They're not getting a credit. They just got an adjustment in a downward way. So I used easy math before. I'll use even easier math. If the loan level price adjustment was a 3% ad before, now it's only 1.5%. They're not getting a 1.5 credit, but they are getting a better ad by nearly 1.5 points. So, or more, actually. It was actually 1.875. So, and our borrowers who are what we would call the middle sector, which I consider like a 680 credit score and maybe 5% or more down, maybe up to a 720 credit score with 5% or more down, they got an ad, a bump to their loan level price adjustment for no apparent reason. They didn't become more risky that I know of. No statistics said that this borrower group was more risky now, where the lower credit score group and with less down became less risky. I don't think that's the case. So yes, the middle sector is subsidizing for a lower credit score, lower down payment. However, they're not getting a credit on the lower end. Now, there was some talk about what middle class is, and maybe like, who fits into that bottom sector, that 620 score and that lesser down payment. And I would potentially agree that that's a big group of people, just everyday Americans who struggle with the current economy, who are at an income pace that doesn't help them to save a lot. They don't have a lot of residual income, and yes, they could definitely use a break. And many people at the lower credit score, lower down payment, their mortgages perform. they pay their mortgage off, and they pay it on time, generally speaking. But they are a higher risk, and there are people who don't pay their mortgage there. There's equally amount of people who don't pay when they have better credit score or a larger down. However, that risk was evaluated based on the ability to pay, which is statistically. So the lower credit score, lower down payment borrower got a cut to their ads, a cut to the loan level price adjustments, even though they're higher risk. And the middle of the sector with a better credit score and a slightly larger down payment did get an increase to the amount of loan level price adjustments that they pay. This is only on conventional loans. So there's an interesting piece that you might be interested to hear, and that is that this type of loan and most loans run through what is called an automated underwriting system. And for lack of better words, it's like artificial intelligence analyzing that account, that application, and just giving a decision, seeing if it meets the criteria. And it looks at many different factors, which we call layered risks. So it's looking at the down payment. It's looking at the credit score. It's looking at the credit history. It's looking at maybe the amount of reserves. It's doing a deeper dive on the credit for maybe, how long have they had credit? Do they have accounts they just opened? Do they have accounts they've had for decades? Have they had substantial credit, like maybe a large car payment or paid off a few cars already, or maybe they owned a home in the past? So looking at substantial credit, looking at overall repayment, looking at all of the other things we look for: credit score, balances in relationship to available credit, credit history, credit longevity, type of accounts, and so on. So the artificial intelligence, or what's called the automated underwriting system, I'll tell you that even though Fannie, Freddie, and who the powers that be that wanted that changed these loan to level pricing adjustments this time and appeared to give a break to that lower grid, generally speaking, if you run that borrower through an automated system, and I have to add that an automated underwriting approval is necessary. You have to get an underwriting approval that way. There is something called manual underwrite, but in most cases, if it doesn't pass through an automated underwriting, it's not going to get a manual underwrite. So the funny thing is that most people with a low credit score and a low down payment and a high debt ratio and very little reserves will not get an automated approval. So even though Fannie and Freddie are saying they're doing this to help that sector and to make home ownership a little more attainable and a little less expensive and a little more affordable and so on, their own systems that underwrite them don't approve lower score borrowers without a substantial credit history, with no reserves, and a low credit score. So that's the truth. People might not want to hear that, but these loans don't even get approved. So you're lowering the loan level price adjustments to help, but their criteria doesn't get through a conventional loan. So most people in that criteria benefit anyway. It's not a matter of like they would want a conventional loan because it has so much benefit and they can't get one. It's not even the best loan product for them as far as rate, as far as mortgage insurance premiums, as far as the minimum down, as far as the maximum debt ratio, as far as the credit requirements. An FHA loan is generally the less expensive loan for them. The minimum down is 3.5%. Conventional can go 3% down. So that 0.5% is probably the only upside to going conventional. There's no other upside. One other might be that the MI drops off sooner than the MI on an FHA loan, but you still have to pay your payment on time for over 2 years. So before you can have mortgage insurance come off. So yeah, FHA loan is the better loan. And so doing all of this and exciting everyone and thinking that, making some people mad and making some people happy. And it's not even the loan that would be best for this particular buyer profile. An FHA loan is an awesome loan. It serves its purpose. It does its job. And changing things on the conventional loan, I don't even think were helpful in the way that they wanted us to think that it was. So loan level price adjustments for the people who are on the higher sector. Let's say you have more than 30% down and you've got up almost an 800 credit score. Those buyers weren't affected. For the most part, there was no adjustments to that upper left corner of the grid, of the heat map. They had very little to any change to the loan level price adjustment. So this is also what makes me say, and what I conclude, is that the middle of the road person that you and I might think is middle of the road, because maybe they're thinking that the 620 score borrower with 3% down is more of the middle sector. But as far as statistics and as far as what we've been told about having good credit and having a down payment to buy a house, that middle sector that got their down payment and managed their credit fairly well, they are the ones that got the increase to the loan level price adjustments. So they are paying the price, and they have, it's pretty obvious, are subsidizing for everyone else, because if they still need to collect this money in order to help to cover the cost and the risk of default, then the burden is heavily on a borrower that has maybe 5% or more down and a 680 to a 720 credit score. They got hit with the slightly higher loan level price adjustments, and they definitely will pay more to buy a home and to get the middle of the road rate. So one thing that I didn't touch on, I'm going to touch on in the next segment, but I'm going to wrap this up in the third segment, because the one part that we still haven't talked about is income. If you have low to moderate income, what happens? So that's up next. See you soon.
Looking to attract your target market without soliciting or doing the cold calling? Call Marie Waite and book your consultation. Branding gives you the power to create a unique and classy perception of your business for your target audience. A marketing plan without the right branding will always cost more, take longer, and tend to deliver subpar results compared to a well-branded business. Marie Waite is a branding strategist who formulates effective marketing and media programs to promote your business in building your name, brand, and legacy. Marie has over 10 years of experience and a proven record of creating strong brand content for business owners, entrepreneurs, and companies using her creative ideas, recommendations, and innovative programs. Book now at mariewaite.com or call her at 951-378-5316, 951-378-5316.
This is Steve Matley. Join me every Thursday at 3 p.m. right here on KCAA for Building Solid Foundations radio talk show. I spent decades as a professional construction manager, business owner, real estate developer, and a college educator, and I enjoy learning new things from other people. We talk a lot about real estate, business, and finance, but we cover a diverse range of other topics as well. Some of the topics we've discussed in the past few months include real estate investing, leadership, higher education, ADUs, marketing using technology, multifamily rental properties, business strategy, entrepreneurship. You never know who may show up or what they may talk about, so join us right here on KCAA for Building Solid Foundations Radio.
Fire Up Connect is the most innovative business networking group, supporting and collaborating with a dozen of small businesses that are interested in building and establishing strong business connections. Hosting educational live seminars while carrying out business and community-driven projects, as well as marketing programs as a part of its membership program. Fire Up Connect also offers virtual assistance with a wide range of services including inbound customer support, chat support, appointment setting and email management, graphic designing, video editing, web design and development, social media marketing, e-commerce solution, content writing and much more. For more information, head on over to www.fireupconnect.com. Fire Up Connect, helping success stories unfold every day.
Real men of real estate.
Men of Real Estate radio show here on KCAA.
Boats, mortgages can be purchased.
All of us want to live in thriving communities.
Basically, go to the radio station KCAA radio.com.
You're listening to Fabulous Lifestyle Radio. I'm your host, Ricky Perry, and we are affiliated with CNBC, NBC News, and Sports, where we broadcast to over 5 million households in the greater Los Angeles area. If you missed our previous shows, you can watch us on our streaming networks on Roku TV, Amazon Fire Stick, and the Android app.
Looking to attract your target market without soliciting or doing the cold calling? Call Marie Waite and book your consultation. Branding gives you the power to create a unique and classy perception of your business for your target audience. A marketing plan without the right branding will always cost more, take longer, and tend to deliver subpar results compared to a well-branded business. Marie Waite is a branding strategist who formulates effective marketing and media programs to promote your business in building your name, brand, and legacy. Marie has over 10 years of experience and a proven record of creating strong brand content for business owners, entrepreneurs, and companies using her creative ideas, recommendations, and innovative programs. Book now at mariewaite.com or call her at 951-378-5316, 951-378-5316.
Hey, welcome back to International Wealth Builders Radio Talk Show. This is Michelle Estelle. I am your host. I am the homebuyer coach. And today we are talking about loan level price adjustments. So we've already spent some time explaining what they are, explaining a little bit about the grid and the heat map that showed which loan level price adjustments were going to increase and which were going to decrease, which started all the talk about poor credit buyers getting a better rate than good credit buyers. So that's what I want to delve into right now, that particular part. Some people were saying that if you harm your credit, run up your credit cards, lower your credit score, that you're going to get a better mortgage rate. Well, that is not true. Because although a low credit score, low down payment borrower got the benefit of these changes, and a better credit score, better down payment borrower does end up paying more, it's still not more than the lower credit score, lower down payment borrower. They still do pay the most. They just got the best improvement on the grid. And then, as I mentioned, your very high score borrowers with your very large down payment had little adjustment. So the biggest adjustment was in that middle sector. An average score, 680 to 720 is going to pay more than they used to, and a lower credit score borrower is going to pay less. So in effect, subsidizing low credit score buyers by charging someone else. So that part is true. However, harming your credit is going to make you pay more, because a low credit score still pays more than a higher credit score. So you can't get a better rate by having worse credit. So I just wanted to clear that up. The other thing is that people were mentioning the down payment, and even I've heard people in the industry saying that when you put more down, you have a higher rate, and they said that was new, but that's not new. If you put 15% down, you have a better rate than if you put 20% down. So that seems a little off and counterproductive, but the reason why that scale tips when you get to 20% down is because at 20% down, there's no mortgage insurance. So if you remember in segment 1, I was talking about the fact that if a lender has to take back the mortgage and they have to sell your house after foreclosure proceedings, it costs them about $30,000 to sell the house on average. Probably sometimes more, sometimes less, but it costs them that much to just sell the property outright. So right off the bat, they can sell it to satisfy the debt. But if the debt and the sales price are the same, they're going to lose $30,000. Either way, they're going to pay about $30,000 out of pocket. So that's going to minimize any proceeds that they get in order to satisfy the debt. So because it has no insurance, there's nothing to cover those costs. And that is why when you go from anything less than 20% down to 20% down, the rate is slightly higher. So that is true, but pretty much for a very long time has always been true. And the reason is no mortgage insurance at 20% down. So you cannot get a better rate by getting a worse credit score. That myth was wrong, and I'm just reiterating that. Down payment does help. Significant down payment obviously reduces the loan level price adjustment for loan to value. The last piece, I think, is the most significant, and very little conversation was had in the social media world, influencer world, political world about the fact that there's one more component to the advantage, and that is if you have low income. If you have a low credit score or moderate credit score, but let's focus on the low end, that grid, bottom sector of the grid, if in addition to having a low credit score and a low down payment, which you're considered high risk, in addition to that, if you are in the low income, could be considered moderate income, it's 100% AMI. If you are at that income bracket, you have 0 loan level price adjustments. So the biggest benefit to anyone is in the low income rate. That's where the person gets the best rate. And definitely, I would say the way that the scales tilt, which I have not actually compared, but if you look at no loan level price adjustments at all, knowing that the loan level price adjustments went up for the borrower that had the 680 or better score, if they have low income, they are going to get their loan level price adjustments waived as well. So let's say they do have good credit and they happen to have a good down payment, so they're already better off. But if they also have low income, they also will get a much better rate. But the person with the low down payment and the low credit score and low income, that's the targeted audience that's getting the best rate of all. They are going to get the lowest possible rate of all of the rates. So the moderate income buyer, the middle sector with the good credit score and even a low down payment to moderate down payment, they're also going to have an advantage if they have low income. So anyone with low income is the winner in the new loan level price adjustments. That is for certain. And I'm not sure why that wasn't given the attention, because that's the biggest news of all, is that anyone else is going to subsidize for the low income borrower. Everyone, even the 620 credit score borrower that still has to pay a higher loan level price adjustment, just not as high as they did before. If for any reason they're not at the low income bracket, but they didn't have a higher down payment and they had a low credit score, they're paying for everyone too with the low income. So 0 loan level price adjustments if you have low income. If you are at 100% AMI or less, you're going to get the best rate on the grid. Now remember, once again, that doesn't even mean that you can get a loan approval, because if you do have a low score and you do have a loan down payment and you do have a low income, even though the income is only going to be relative to the amount that you qualify for monthly payment, so all things equal, the payment that you qualify for is the payment you qualify for, but the opportunity to have the lowest possible rate with no loan level price adjustments will still mean that you need to get an AUS approval. And it seems that it's very tough to get a loan approval like that if you don't have substantial credit. And with a 620 score, it's probably a given that you don't have substantial credit score. However, somebody with a really good credit score with just one 30-day late recent can drop their score a bit. So there's 1,000 different scenarios that we can talk about between all of these risks, which is down payment, credit score, debt ratio, property, basically. We could put together thousands of scenarios at different scores, different down payment, different income bracket, different types of properties, and some people can get approved and some people can't, which is the other part of all of the scenario is there is no one size fits all. And that's what I said in the first segment. When you call and ask me what are the interest rates, there are no interest rates. There is a bunch of opportunities for interest that you can get, mostly based on your specific situation, credit score, down payment, debt ratio, the program that works best for you, the property that you're buying, and all those things are going to determine what that score would be. There's also an inversely proportionate scale of interest rate. So if you said, well, I really want the rates to be 5, there is a 5% on that sheet. It's just that it comes with a cost, and those are Similar to loan level price adjustments, those are discount points. So everything starts at a base rate, and then the LLPAs are added to it, whichever apply to you. And then if you have low income, they're all taken away. So you have zero ads, but you still have the cost for that rate, the base rate, without the LLPAs. So if you wanted to get 5% on a rate sheet with no LLPAs, maybe you could get that for paying a few extra points. You can get a really low rate. That would be a permanent buy down. You also can do temporary buy downs. So those buy downs that are temporary are payment buy downs. They are not rate buy downs because the rate remains the same on the note. You just get a subsidized payment for a period of time. And that's like paying that additional part up front by somebody in the transactions. For instance, the seller or the lender putting the money up to subsidize the payment for a temporary amount of time. But there's a lot of rates on that rate sheet. And I would say, if it goes about 8 or 9 deep, that if you had enough money and if the numbers work out for the California high cost and you can pay enough points, there's a possibility to get a lower rate than you would think, a lower rate than may be advertised by buying that rate down. But we always start at the base rate, and then we add all of the loan level price adjustments on top. And the number one thing for this segment is if you have low income, no loan level price adjustments. So winner, winner, chicken dinner for the low income person gets the best rate. So next segment, we're going to wrap all this up, and I'll be back soon.
Real Men of Real Estate.
Men of Real Estate radio show here on KCAA.
Boats, mortgages can be purchased.
All of us want to live in thriving communities.
Basically, go to the radio station, KCAA radio.com.
You're listening to Fabulous Lifestyle Radio. I'm your host, Ricky Perry, and we are affiliated with CNBC, NBC News, and Sports, where we broadcast over 5 million households in the greater Los Angeles area. If you missed our previous shows, you can watch us on our streaming networks on Roku TV, Amazon Fire Stick, and the Android app.
Looking to attract your target market without soliciting or doing the cold calling? Call Marie Waite and book your consultation. Branding gives you the power to create a unique and classy perception of your business for your target audience. A marketing plan without the right branding will always cost more, take longer, and tend to deliver subpar results compared to a well-branded business. Marie Waite is a branding strategist who formulates effective marketing and media programs to promote your business in building your name, brand, and legacy. Marie has over 10 years of experience and a proven record of creating strong brand content for business owners, entrepreneurs, and companies using her creative ideas, recommendations, and innovative programs. Book now at mariewaite.com or call her at 951-378-5316, 951-378-5316. Looking to attract your target market without soliciting or doing the cold calling? Call Marie Waite and book your consultation. Branding gives you the power to create a unique and classy perception of your business for your target audience. A marketing plan without the right branding will always cost more, take longer, and tend to deliver subpar results compared to a well-branded business. Marie Waite is a branding strategist who formulates effective marketing and media programs to promote your business in building your name, brand, and legacy. Marie has over 10 years of experience and a proven record of creating strong brand content for business owners, entrepreneurs, and companies using her creative ideas, recommendations, and innovative programs. Book now at mariewaite.com or call her at 951-378-5316, 951-378-5316.
This is Steve Matley. Join me every Thursday at 3 p.m. right here on KCAA for Building Solid Foundations radio talk show. I spent decades as a professional construction manager, business owner, real estate developer, and a college educator, and I enjoy learning new things from other people. We talk a lot about real estate, business, and finance, but we cover a diverse range of other topics as well. Some of the topics we've discussed in the past few months include real estate investing, leadership, higher education, ADUs, marketing using technology, multifamily rental properties, business strategy, entrepreneurship. You never know who may show up or what they may talk about, so join us right here on KCAA for Building Solid Foundations Radio.
Fire Up Connect is the most innovative business networking group. supporting and collaborating with a dozen of small businesses that are interested in building and establishing strong business connections, hosting educational live seminars while carrying out business and community-driven projects, as well as marketing programs as a part of its membership program. FireUp Connect also offers virtual assistance with a wide range of services including inbound customer support, chat support, appointment setting and email management, graphic designing, video editing, web design and development, social media marketing, e-commerce solution, content writing and much more. For more information, head on over to www.fireupconnect.com. FireUp Connect, helping success stories unfold every day.
Welcome back. Thank you for joining us for this last segment of the International Wealth Builders Radio Talk Show. I am your host, Michelle Estelle, the Homebuyer Coach, and we spent this show talking about the loan level price adjustments, the myths behind getting a better rate if you have bad credit, and explaining actually what loan level price adjustments are and what actually occurred with the changes this time. Again, to summarize, the loan level price adjustments have always been there. They've changed over time before. This time, low credit score borrowers with low down payment got an improvement, whereas the middle sector with good credit to very good credit and maybe slightly larger down payment pay more. So there's no argument that they actually pay more, which appears to be the subsidy for the lower credit score, lower down payment borrowers. But as I mentioned in the last segment, the big part that a lot of people didn't talk about was that if you do have low income, you have all of the loan level price adjustments waived. And that would be in any of those sectors. If you're in the low income, the loan level price adjustments would be wiped out, waived, brought to zero. So a good credit borrower could also benefit from that if they're low income. So that, though, is the biggest adjustment. We've also talked about the fact if you put more down, you actually could pay a higher interest rate, and why that is. That's because of mortgage insurance. Mortgage insurance goes away after 20% down, but the cost of taking back a property through the foreclosure proceeding does cost the lender money. So without that insurance, they do pay those costs out of pocket. So I do want to thank you for joining us today. We are on KCAA Broadcasting Network. We are on 1050 AM and 106.5 FM. And if you've missed any of our previous shows, you can watch us on the TV streaming channel distribution, Roku TV, Amazon Fire TV, and Android apps. Just subscribe to the Building Solid Foundation channel to watch all of the previous shows. Some great information there. Next show, we have not announced the topic yet, but that will be coming soon. And I just want to thank you for joining us and listening to all the great education provided on this network. If there's anything that you're not getting and questions that you want answered, just reach out to me. I am Michelle Estelle, your homebuyer coach, and my phone number is 909-229-1730. Last month's show, we talked about generational wealth, and I kind of was sharing my thoughts about how there's no guarantees in either situation, meaning if you come from a family that doesn't have much, or if you come from a family that does have much, that there's no guarantee that the outcome will be that that wealth will continue to the down generations. And there was one thing that I did mention or did not mention that I thought about afterwards, and that's the number of siblings, number of people in the household. This is also something that I thought about that makes a big difference, because if you are an only child and your parents leave you everything, obviously that's a good lift for your life, depending on how old you are, as I mentioned. But you also are the sole heir. And so if your parents do leave you everything, then you get everything. But if you do have multiple siblings, all of their estate is divided up. And so if they had you when they were young, which was one factor we talked about, if you have multiple siblings, and if if your parents have went through some tough times and so on and don't have a lot left in their estate at the time of their passing, or they needed long-term care afterwards, and you add the siblings to that scenario, and you're already old when your parents die, there's just really no scenario that guarantees that just because your parents had wealth or just because your parents owned a home, that you will also have a benefit from their wealth. Most all wealth, at least I can use in the middle sector, most all wealth is something that each generation is going to have to work for and save for their self, which is why financial education and passing on information and responsibility to your kids is so important. I am very passionate about that because we are continually told that families don't talk about money or teach their kids about money, and we don't teach it in schools, which is the number one thing that we should be teaching people, young people, about debt, about savings, about cost, about budgets, and kind of delaying the gratification in purchasing things right away, or buying a car cash that's used, or buying the smaller house first and moving up, or saving up money at a small rate for a long period of time to get something that you really want. Those are the things that we definitely should be sharing with our younger generation and teaching them a better responsibility with money, because we're not doing a very good job at that right now, and we're too caught up in other things instead of teaching basic skills, and money is a huge part of skill set that we need for our young people. So I thank you for joining us again. This is the International Wealth Builders Radio Talk Show. I am your host, Michelle Estelle, and I am the Homebuyer Coach.
.106.5 FM and KCAA 1050 AM.
I always hear from our clients who hired another firm that they wish they'd hired DNA Financial first. Don't have regrets about your IRS tax case. Just hire the best in the first place.
One owed $150,000 to the IRS and had spent thousands on another firm. We stopped the levies, negotiated a payment plan, and had